important spectrum to sort of review and to deal with in terms of framing the problem of going from traditional philanthropy to traditional institutional capital in terms of banks, mutual funds, and pensions. And you have this continuum that takes you from traditional philanthropy that seeks to maximize a social return. In our case of Pups for Peace, by the way, that's www.pupsforpeace.org if you want to read more about it. But our social return was to try to save lives and prevent the damage from terrorism. So that was the social return. That was a clear-cut issue, but in order to broaden that and put it on more sustainable feet, we have to find ways to keep that going and not be totally dependent upon our own wallets or foundations, and to find sources of revenue that might be more appropriate. Then you have venture philanthropy, this idea of seed capital for innovative social programs that don't require any particular market return on investment, and the issues of documentation. Then you have the things that we were talking about earlier, Penelope Douglas's model on community development equity or venture capital, how that works in terms of providing patient equity, angel investor and social venture capital returns, then socially responsible investment funds. You got what is it up to, like $1.2 million now? $1.2 trillion, what am I saying? About $1.2 trillion in screen funds that are operative. So that that's another, and then you get to traditional. So I think the question here is, as you go from social equity to private equity, and I just love the use of those terms because equity, again, it brings us back to the moral philosophers, right? Equity did have those two dimensions, just as wealth and ILF did. Equity had both, was the financial expression of equity, was in a sense to provide the returns of ownership. And we, those of us trained in finance need to remember the moral the origins of that philosophical term of where equity, what it means and what you're trying to create. Within that context, I think something very innovative, and Sherry can talk more about it tomorrow, and we've done some work for the Heron Foundation and the Ford Foundation as well, is to look again at this type of investment continuum, going from below market investments to market rate investments, and covering this continuum again from equity, subordinated loans, senior unsecured loans, cash, guarantees, cash, fixed income, private equity, public equity. This represents an array of the type of instrumentation that's important. And then Heron is a foundation. FB Heron Foundation's I think they're down to about 350 million. Yeah, and so their goal is to put all of their money, both their corpus as well as the other portion of their investment, to move it all into mission-related investment. And it's very interesting to look how they've done that. And Luther Reagan and the people at Heron have been a real pioneer, I think, in the foundation world on that level. What are the approaches to financing growth? To launch an income-generating business subsidiary. We've heard several examples about that. I would just either say to launch or to do joint ventures or to find places where there may be appropriate business combinations of however they're framed or structured that would benefit and provide some revenue feedback into the social mission. To recapitalize existing businesses and to introduce financial innovations. And I think we'll go into a few of those. I'm going to skip factoring. I'm going to skip this one for a reason. Let me talk about loan securitization for a minute, because that's one that we've been working on recently. We're working on a project called the Isabella Project up in the Bay Area, which I believe represents the first attempt to do a collateralized loan obligation that's targeted to community development revolving loan funds or community bank investments that would focus on trying to make people more economically independent. Securitization, I think, is one of those great financial revolutions, or part of the financial revolution of the last 30 years. And it's the process of issuing securities backed by cash flows from an underlying asset. And clearly, ones that everybody's most familiar with are the way that we've been able to finance 68% home ownership in this country over the last 60 years. And then particularly what revolutionized the world of the Government National Mortgage Association, or the Federal Mortgage Corporation, that we now euphemistically refer to as Fannie Mae and Freddie Mac, which are more controversial, and we like to not think that they were government sponsored, but and they would like to sometimes have us forget that. But nonetheless, the existence of the financial innovation of the mortgage-backed security market really enabled those pass-through securities to manage to convert illiquid loans into liquid assets and put those on the balance sheet and create active trading and liquidity in those areas. It was able to reduce the credit risk, the lender's credit risk, again, by pooling. Again, back to my old colleague from when I used to teach at Baruch, Harry Markowitz, was the whole problem of, how many eggs in which basket. And the whole question, the underlying issue about portfolio theory was the question of diversification. And it's also solved issues in part, not completely, but issues like discrimination, because if you buy a CLO, if we can get institutional investors to buy the CLO of Bay Area small business revolving loan funds, they won't care whether they're black, Chinese, gay or whatever. They'll just care whether or not they're performing, and they'll provide a credit flow, a cash flow into those businesses. So I think that's really the important kind of issue, is what securitization does in terms of breaking down barriers that are non-economic barriers to access to capital and access to the opportunities to create wealth. That's what we need to do in the emerging world. It's what we need to do in the environmental markets and in other markets, the housing markets and so forth. It allows these lenders to sell portions of their loans and make new loans with the sales proceeds. And here you see just a brief little diagram of a sample CLO, how it works. And this, again, great legal and financial revolution of our times, the special purpose vehicle, which got a lot of bad names for some very good reasons in terms of its misuse at Enron, but really has represented how we have financed public finance in this country, how we finance private partnerships, how we've cleaned up rivers since the 1980s with the Environmental Protection Agency, state revolving loan funds, which have dealt with wastewater treatment. I mean, all of these bonds, some of you may own some of them, but they've been examples of ways of utilizing a single purpose or a special purpose authority in a legal entity, in a corporate entity, to basically absorb its particular purpose. But that's what we need to do in these illiquid markets, or places where there have been real barriers to capital access and in terms of what they're operating. An example there is what the insurance industry did in this state with Impact Community Capital, which is a limited liability corporation owned by 8 major insurance companies. The company purchased loans made by banks, non-bank financial institutions, nonprofit organizations in lower and moderate income areas, and securitizes them. And that's, again, what we're trying to do there. Now, an example that again, is an example that comes out of work that's been done by Calvert and Heron and some others you may hear more about, is developing loan pools. A pool of loans that's co-owned or shared by participating institutions and is designed to provide members with flexible funding for challenging projects. What happened was to take 10 of these, and we've done some of the diligence on them, from community development corporations, combine them into a corporation, a Sustained Excellence Alliance Corporation. And they've had a public offering, a $5 million public offering with a $300,000 first loan loss pool. The 10 community development corporations, what they needed was they needed flexible capital that could be drawn upon during initial stages of a project for planning, research, and development. To satisfy that need, C Corp then teamed with the Calvert Foundation. They created a program-related investment to raise capital and create a fund for member organizations to access that pre-development money. As with Wall Street offerings, the PRA transactions had different groups of participants.